4% rule is too high? No, says the inventor of the 4% rule, Bill Bengen. You should use 4.7%. But I appreciate Bengen. I find it funny. 4.7 as the 0.10, the 10th of a whatever it is, 4.7, 4.6, no, too low, 4.8 too high. I get it. I just always chuckle how specific we are in future, which we don't know what the future consists of. All right. So let's dive into this. I do like this. I've done this article probably about a year or so ago when Bengen first came out with the addition to his initial 4% rule. And look, as an FYI, I like Bill Bengen. I'm not bashing Bill Bengen. I just find it the whole thing is silly when you're saying you're going to spend on a linear basis adjusted for inflation, which there's no evidence that. And in part two, we're dealing with unknowns. We're looking hindsight to project that in the future, which I don't like. By the way, what does my shirt say? What do I love? Anyone want to guess? If you guess CO2, you win the Jeopardy round. You win. I love CO2. As you should too, because we all need that fertilizer if we want to make the world green. All right, so the IBD Investors Business Daily, dateline and December 22nd, 2021, says retirement advisors are cautioning the 4% rule no longer works. Those doubting Thomas say if you withdraw 4% each year at a percentage equal to inflation, your retirement won't last 30 years. Those skeptics say that following the 4% rule will bankrupt you. Your IRAs will be as empty as the Mojave Desert. Too early, too. But is that true? One financial advisor, Bill Bengen, disagrees. Bengen says, if anything, the 4% rule is too conservative. Retirees do not need to limit their savings to 3 to 3.5%, as some financial advisors recommend. Instead, retirees can safely withdraw up to 4.7% without threatening to wipe out their retirement savings, Bengen says. The reason why so many people think the 4% rule is out of date is that they overlook its premise. When I did the original research, I was looking for the worst possible time to retire. That was late 1968. Why was that the worst possible time? At that time, a retiree would have had to endure two big bear markets from 69 to 70 and 73 to 74. After that, the high inflation of the late 60s and 70s caused the retirees to increase their withdrawals in an unusually large amount each year to keep up with inflation. Those large withdrawals boosted the odds of early depletion. To avoid running out of money, 4% was what he came up with. But recent decades have been Goldilocks in comparison. Bull markets have pumped up the value of retirement accounts, and low inflation has put a much smaller dent into the buying power. So you see what he's doing. He's saying low inflation or a high inflation is a killer, not so much an initial bear market. I'm going to run some numbers on it. We'll see. All right. So anyway. Many retiree investors taking 4% plus inflation adjust withdrawals have seen their retirement savings grow, not shrink. Yeah, well, he says retirees can now afford yearly withdrawals at 4.7%. I'm surprised that he's. We'll keep reading and then we'll go from there. How much does Bengen withdraw from his own retirement savings? He's 74, so he. At that time, he retired in 2013. So he's 74 now. He retired 9 years ago at 65. Okay, so he was taking 4.5%. He has reduced it to 3.5. It's because his accounts have grown so much. There you go. 100%. I completely agree with that. There's another reason the 4% rule works is that some skeptics do not seem to read all of his research, including updates. Skeptics ignore the fact that 4% rule is based on the worst case scenario, 100%. They make no allowance for the fact that we are far from those worst case days. Just because of what we've had in the past doesn't mean we're in the last. I don't get that you can say we're far from the worst case days. We don't know that. That's a weird observation. We're far from those worst case days. What if we went into the next 2 years? I don't like that at all. High yield bonds and stocks entail higher risk. Interest rates are historically low. Well, that would tell me that we're not away from worst case days. We could be going. The difference in our withdrawal rates appears to be accounted for by the difference in our forecast for future returns. Exactly. Some assume a very low rate of return for many years. In addition, Bengen originally described how retirees' portfolio was expected to behave on just 2 asset classes, and now he's got 5. All right. We got any comments on here? No. Yeah, look, I could not disagree more that we're far from our worst days. Did you know in 1967 and going into 1968 that the 70s would be the way they were? No. In fact, the 50s and the early 60s were fantastic. So that doesn't make any sense at all. If you just look at the inflation rates of the late 60s, they weren't so bad. Not bad. I don't know. That's weird to me. I don't understand that at all. I just like at the end of the day, the 4% rule is based on a false premise. Your spending increases each and every year with inflation. There's no evidence of that, none. So I'll let you figure that one out. All right. Love to hear your thoughts. Thanks.